And I'm going to start recording as well, if you don't mind, John.
Do you see this?
Yes, I do see it.
All right. Hi, everyone. Thanks for joining us tonight, VP. Thank you for inviting me to speak. My name is John Alden. I own a brokerage based in Santa Monica called Alden Pacific Investments. And we really focus on helping our clients buy and sell small to medium-sized apartment buildings. So usually that looks to be about 5 to 25 units here in Los Angeles and parts of Northern Orange County, as I mentioned before. Tonight, let me see if this is going to work. Okay. Yeah. Tonight, I'm going through the introduction right now. Wanted to talk a little bit about looking back. We're kind of coming up on a year of COVID. I know we've talked about it to death, I'm sure, on every podcast and news article, but it has changed the landscape a little bit locally, and some of the stuff we have to account for now when we're making investments. Then I'm going to get a little more specific to California, and then locally in our local submarkets where we focus. Moving forward, what we think will change, and then opportunities that investors will have. Like I mentioned before, we specialize in working with companies and investors, helping them buy and sell those small to medium-sized apartment buildings. We take a lot of pride in really we are not volume-based. We take that very seriously. We are a boutique brokerage. So what that means is we spend a lot of time with our clients, helping them understand what they are looking for, understanding why they're looking for it, and then either sourcing the deals or disposing of the assets for them. Typically, they're going to, if they want to do exchange out of state, we'll set them up with, out of state brokers that we trust, have worked with, help them underwrite those deals as well. Okay. So without further ado, big news of 2020. COVID-19. Like I said, we're all probably sick of hearing about it. March of last year, shutdown started. I was actually reflecting on it the other day. I don't know if anyone here wants to talk, but that feeling of impending doom when those shutdowns went into place, I was just thinking like, what's Zoom? How am I going to use it now? You know what I mean? You're just kind of like, is the world going to end?
Hey.
Sorry, what?
I'm so irate that I had to call. So before it switched, was Corey in first or second place?
I think his, let me just mute.
What?
I mute. I think he was, I don't think it was relevant to the conversation. Yeah.
Okay. Irrelevant.
Go ahead. Yeah.
All right. Yeah. But yes, the irate feeling was what I felt too immediately. Small to medium-sized investors were horribly impacted by this. To no fault of their own, a lot of our tenants were unable to pay rent. We got left holding the bag. It was kind of thinking, how are we going to work around this? The state put in place AB 38 and SB 91 more recently, which we're going to talk about. There's a federal eviction moratorium as well. The Fed unveiled a massive stimulus program, which I don't know if anyone paid attention to Jerome Powell's comments a few days ago. Looks like kind of unlimited buying for the near future. So hopefully those rates keep staying low. And then the Fed, began this massive action to prop the economy up. Forward here. Sorry, I gotta get back to my. So let's talk a little bit in more detail about that actual COVID kind of the day the world changed. So immediately employment jumped to 14.7% in April 2020. It was 6.7% as of January 21st. So we're already seeing quite a bit of recovery. And I think if you look now, I mean, it's even lower. But to put it into perspective, though, and the reason I wanted to talk about it is the Great Recession had greater than 7% unemployment for 59 months. So although this felt like forever because we were all stuck inside and couldn't leave the house, this kind of was like a giant, like a big spike, and then kind of started leveling off relatively quickly. And this graph over here on the right was where you can really take a look at what that unemployment looked like. GDP growth obviously was impacted very heavily, but again, it's seeing a relative bounce as well. The big thing also that we had going on was this Fed just unleashing like so much quantitative easing, the likes of the world have never seen. Has anyone seen this graph here?
No, not really.
Okay, so this is looking at quantitative easing since 2008. And you can kind of, if you look here of what happened during COVID, it just was insane what they just unleashed a nuke, I guess. So that being said, what I always like to say to people is I think we were due for a correction even before COVID. I think it was in October 2019. The Fed had to start injecting, like hundreds of billions of dollars into the overnight markets again. And everyone was asking Jerome Powell, they're like, is this quantitative easing? Like, are we in trouble? He's like, no, it's not quantitative easing. But it was like, we were kind of waiting for the straw to break the camel's back, and we ended up with a boulder, is what I said. Is what I've said to people. And so the Fed's reaction, it was almost like they were justified in kind of unleashing the artillery to prop this up. In California, we were really disproportionately affected. We had very strict and very long shutdowns. The legislation that was put in place was stricter than we've seen in other places of the country. That also, businesses had been leaving the state by the thousands prior to that. Fiscal year ending July showed a net loss of 74,000 people from LA County. So I don't know how many people talk about California is dead and it's no good anymore. And the COVID economy impacted people differently as well. If you had a good white collar job, you were probably way less affected than your tenants living in your buildings. Ken, I don't know, were your tenants impacted at all by COVID or?
Well, they were able to pay, the ones I had were able to pay rent, but I got vacancies during the time period where people just, moved out.
Yeah. So everyone's been suffering through it. But this is kind of my big thing for all this doom and gloom. California is still an economic powerhouse globally. We have this incredibly highly skilled workforce, very diverse industries, and we don't have enough houses. There's a supply and demand problem, right? So when the COVID thing first happened, I had a lot of people coming to me saying California's dead, LA's dead, no one should buy here, blah, blah, blah. And you just keep coming back to we just don't have enough housing here in the state, and it creates a horrible supply and demand problem. There's not enough room to expand, and the demand for the housing continues to be there, especially affordable housing and like class B and C types of housing that we talk about typically. I'll stop for a moment here and start talking about some local submarkets, VP, which I think you mentioned you wanted to do.
Yeah, that's perfect.
So when our clients is like, I'm assuming most people here are looking for real estate to buy, correct?
Yeah, you can say
okay.
that.
So when we start sourcing properties, we're not usually looking for high-end housing. I don't know if anyone picks that. We're usually looking for, is everyone here pretty sophisticated as an investor, VP, or what do you say? Or
Say it again.
is everyone here seems like everyone here's done a few deals or kind of understands.
Yeah, I think a few people, at least one deal. They have done at least one deal.
Okay. So the kind of projects that our clients are looking for are typically for Class C housing in urban areas. So that I mentioned Long Beach is like one of our top markets. Santa Ana is really hot right now with a lot of investors. And local submarkets in those areas, a lot of our clients want to get because there's such a high demand on the existing housing stock that if you can buy an asset and have it perform relatively well with the existing tenants in place and then slowly stabilize that property over a period of 3 to 5 years, you can generate these massive returns on equity on your across your portfolio if you do it correctly. What was really difficult about COVID was the banks who are making the commercial loans immediately really tightened down the requirements that, or the amounts they were willing to lend on. We weren't able to get the leverage we needed. They were requiring a lot of COVID holdbacks. So it created this situation where on 4 units and below, rates were at like all-time lows, and all of a sudden we see those prices start climbing, and on the 4 units. But the 5 and ups, we just couldn't get that leverage, and it was really difficult. And so that actually had a ripple effect kind of throughout the market, and transaction volume, I think we looked locally kind of where we play in the areas we play in, was down about 50% last year. So kind of crazy stuff if you think about it. I'm going to kind of blast through this. So now as we start going through this kind of economic reopening, we begin to start thinking about how do we need to adjust our strategy because of COVID. The first thing is the new legislation that's been put in place. California is a very tenant-friendly state. VP, I think Oregon is as well, or starting to be.
That's right.
So how do we adjust our strategy with new legislation? Is everyone here familiar with California rent control?
Yeah, you can't increase more than 4%, right? If it is built before 1975 or something.
Do you want me to take this on a little bit of a tangent? Kind of talk through
Sure,
it?
yeah.
Okay.
Yeah, talk about it.
Okay, so California, prior to, well, let me think this way. AB 1482, California as a state is governed by AB 1482, which is a relatively recent law. And in states that didn't already have, or in parts of the state that didn't already have stringent rent control, it limited rents to increases to 5% plus CPI every year. So that before COVID, that was like 8%. In other submarkets across the state, there are stricter versions of rent control. The strictest being, so I'm sorry, I'm blanking on the name of the big law that sorry,
that's okay. You can
sorry, I have to look it up because it's going to drive me crazy, and I can't talk about it without it. Anyways, I'll just speak without it. In the early so anyways, prior to AB 1482, local municipalities were putting in their own rent control ordinances that were very strict. So you'll see like San Francisco, Berkeley, West Hollywood, they have Santa Monica, they have very, very strict rent control ordinances. And then the state passed a law. So what those cities started to do was they started to threaten something called vacancy control, which is the type of rent control that you might see in like a New York City. If that's example. So that's if a tenant leaves the unit, you can't raise your rents all the way up to market. The state then implemented a law, which is the one I'm drawing a blank on. I'm so sorry, I can't remember the name of it. But basically, they said if you're going to put new rent control in place, we're going to cap rents at we're going to put a rent cap in. There's just cause evictions only in place, but they also really made sure that vacancy decontrol was still maintained and a big part of owning real estate in California. So AB 1482 was then passed kind of on top of that law as like a layer. So there's all this legislation that causes all these problems for property owners. And something that a successful owner can do, or a successful operator, what they really need to be able to do is how do they stay on top of this legislation? So COVID-19 happened, and then the state put in place another eviction moratorium, which was really difficult because the way investors were creating value under AB 1482, that statewide rent control law, in areas that previously hadn't had rent control legislation, was AB 1482 allowed you to remove a tenant from a building if you were going to make quote unquote substantial improvements to that building, as long as you paid them 1 month of their current rent and the unit was going to be vacant for 30 days. That was kind of the little workaround for investors. Obviously, all of a sudden, when you can't do that anymore, tenants don't have to pay rent. It creates all these problems. So how do we adjust to that? Becomes a big change. Negotiating requests for repairs. So as operators now, when we're starting to look at stuff, when we start looking at due diligence for a property, like I had some clients buy a 14 unit in Long Beach the other day. We went in and got the rent roll, and 60% of the tenants were in arrears, and they had, they hadn't paid rent since the beginning of the pandemic. We had the property at a great price, so we're going to go forward with it. But our negotiation on the request for repairs was we're having the tenant hold back money now for us, so the tenants can pay rent, if that makes sense, so the bank can get around it. Due diligence impact. So like, how do we protect ourselves? Also, when we're looking at those tenant bases and those rent rolls, like some of the stuff we're looking at now are rental applications, so we can look at what jobs the tenants have when they move in. We're looking at, like, if they are in arrears, we're trying to diagnose why they're in arrears, because these are all things that, especially if you're like pooling other people's money together, can cause big problems if they're not addressed or taken care of carefully. The other thing is paying attention to what commercial lenders are doing. And what we're seeing now, luckily, is that lender impacts. We're starting to see these 5 unit and up lenders coming back in. A lot of them are doing away with their COVID holdbacks. They're allowing for more leverage. Leverage is beginning to increase again. And then the big thing that we've seen a lot of banks coming back in with the type of product that we're using before is they're using interest-only products again. They're getting more aggressive with their interest-only products. Rates, we've seen also the good thing for 5 units up, rates have remained relatively flat because not all, this is a little confusing if you've done mainly 2 through 4s, but not all commercial banks base off the treasury or the swap rate. Some of them do it internally. So we're seeing rates remain relatively flat. So there's been concern about that 30-year rate jumping up recently. I don't think that's going to happen in the commercial space. I think it's going to be kind of more of a boom time for that 5 and up, and prices are going to go up. This is another thing I wanted to talk about. There was a lot of talk about property, about renters leaving these dense urban areas during COVID. I don't think that's the case, and I don't think you're going to see a significant drop, especially among workforce housing. I always like to show this slide when I talk because I like to say history doesn't repeat itself, but it often does rhyme. If we look at the 2008 recession, we can see that inflation actually, we entered that deflationary period briefly, but the actual rents never went negative. And we've seen that in this workforce housing that we particularly specialize in during the COVID pandemic. I own some stuff up in Silver Lake, which is a rent controlled market. So we have some tenants who are paying like no rent, and then we target the hipsters. On the hipster units, we've had trouble re-renting, like targeting those super high end rates, but there still is a lot of pressure on that workforce housing, and there's not enough of it. This graph just kind of talks to the same point I made before. Even though we went through a recession in 2008, price of a home dropped, but rents continue to increase. We're still not building enough homes right there. So this graph, this slide I put in here, even though it was from a talk we gave at the beginning of the pandemic, but a few things that we thought, if you're in trouble as an existing owner because your tenants aren't paying, Working with a lot of people are able to work with banks right now. We're seeing a lot of operators starting to defer capital improvements as well if they can. And then we saw a huge jump in cash out refis last year. Some of my friends in commercial lending, they had record breaking years and only did like 4 purchases or something. We're also telling our operators to just hold back more reserves due to vacancies. Like you mentioned, Ken, those vacancies hurt. They're not fun. So the more reserves you have, the better. We do think that evictions and vacancies are going to grow as we kind of come out of this recession. And rents aren't going to skyrocket. What we are seeing on the type of units that tenants are looking for, 2 units and up right now, if you can get two unit properties, you'll be in really great shape because work from home is here to stay. People are not going to be leaving and going to other places right now. It's also a great opportunity if you're in a rent controlled area for buyout opportunities for tenants. So a lot of people are kind of feeling the squeeze. This is a great time to approach a tenant for cash for keys. Just say, hey, I know times are tough, open to leaving. Also the opportunity to build ADUs. So the new California state law, you can build ADUs on multifamilies. So we're seeing a lot of our clients doing that as well. And that's a great opportunity to add equity to your buildings. And then on the acquisition criteria, this is a great opportunity. I personally believe, and there's a couple different schools of thought on this, but I think we could be in for a big bubble in the coming years, just due to how much cash has been printed. Some people say, oh, it'll never happen. The Fed can handle it. I personally think we will see that happen. And this is a great opportunity. If you can buy, real estate can act as a hedge against inflation as an investment vehicle. This is also a good opportunity. There are still over leveraged owners out there. I personally bought a triplex during this in the middle of COVID from an over leveraged owner and got a great deal. So yeah, there's good opportunities out here, especially on the 5 and up space right now. There's a lot of people who've been kind of hammered hard with non-paying tenants. They can't really do anything and they're really feeling the squeeze.
John, I have a question on your previous slide. Actually, you said defer mortgages. Can you do that for multifamily? I mean, you can do that for your own primary residence, right? But
different banks were allowing people to do it at the beginning of the recession, and they're still open to working with you. Now, if you're looking at an acquisition standpoint, though, like when you go to buy, they're going to vet those COVID holdbacks that they had implemented really kind of prevented people from getting over leveraged on a purchase. But if you were having trouble, they were working with people. It's just kind of more bank by bank.
Okay. So essentially you're saying there's a buy opportunity right now because the assets are troubled and you can probably get them cheaper than usual, right? Am I correct?
No, kind of. But so getting a seller to sell can be a little challenging always. And it sometimes feels like being able to talk to them at the right day is key, for us, we're always trying to dig up deals. During this recession, if someone has had a pain point due to money or something like that, that pain point has been exacerbated. Significantly, obviously, because if you don't have a tenant and you have vacancies or, it just, people are feeling the squeeze still. And those deals are out there. It's just kind of finding them is the challenging part. Just because the way, 5+ unit properties underwritten, they're pretty strict about the DCR they're going to underwrite to. So even if you have 1 or 2 tenants not paying on a 10 unit, property still be cash flowing, so they're not going to be too hard. It's usually the people who are living off the actual asset themselves, and then all of a sudden their incomes hit, they don't want to deal with it. So I'd say it's a good time to buy if you're dealing with like owner operators who are a little more unsophisticated. We've had a lot of success talking to them, and kind of, especially if they're older, this pandemic has just been a disaster for them. So any questions?
Yeah, I've got a question. Back to your ADU comment. I noticed that LA recently started a pre-approval program for ADUs. How do you think that will work, moving forward? Do you think that we'll kind of just see an influx of people trying to use those pre-approved plans to add units to their properties? Or do you think that, they haven't really marketed it well enough that, people might not actually take advantage of it?
The people, so again, I love ADUs. VP, I think Oregon's doing something similar, right, with ADUs right now.
Yeah.
Yeah. Most of the investors we're working with are, if they can afford it right now. I'm doing 2 of them, I think, right now. Yeah. I think the weird thing is right now is that commercial banks don't know how to lend on them. How are they going to treat that? Eventually they will treat that as income. But it might be, 18, 24 months until they do.
Yeah, there's a lot of ADUs going on right now. I know at least 3 people right now in just my friend circle where they're either adding ADUs or have completed their ADUs. And this is on West Side. So there's a lot. My neighbor is adding ADU right now, and it's actually, his work is finished now.
The thing that's interesting is the cost to build them. The cost to build right now is skyrocketed because, if you look at supply, someone showed me a graph of lumber prices recently. It's but also the contractors, they know they can charge more now, so there's that price to build them is going up.
Yeah, I think the rush started even before COVID. And so I'm not sure, what change COVID has done to that, but definitely I was seeing this before even COVID started, that people were starting to build ADUs more. Yeah. But wouldn't that lower the rental prices eventually in LA area? Because now all this capacity is being created, right?
We're so far behind. It's not even I should include, there's an article I read. They were saying we are, especially, if you look at the building trends and how things are being built right now, it's creating a weird problem, it's creating an issue because the only thing that pencils to build on new build is luxury housing, and affordable housing, which is what's really needed, is not being put up. And then on top of that, a lot of these older multifamily properties, we lose, a certain amount of our housing stock each year. So this problem's kind of getting worse and worse and worse and worse. And there's no real resolution that's been posed. It's hundreds and hundreds of thousands units short. You can put up all the ADUs you want. I think it wouldn't be like a drop in the bucket. So.
And if we acquire a property, the part that I didn't understand well is if I acquire a property right now in LA, is there a way for me to kick out the tenants if they're too far, if their rent is too low?
You can't touch them, basically. Yeah.
Okay. So cash for keys is the only way.
Cash for keys. Yeah.
Okay.
Unfortunately. But.
And then and you said we used to, if you're improving the property significantly, then there was a way, right? Or that way has been killed by newer law?
No. AB 1482 is the state law that so Long Beach, where we work a lot, is governed by AB 1482. Under AB 1482, if you're going to make significant improvements to the property, it's going to be vacant for 30 days. And, so you're pulling permits, you can relocate a tenant for 1 month's rent. You cannot do that in Los Angeles because Los Angeles is governed by different rent control laws.
Oh, I see.
So, yeah, the rent control tangent was one I should not have gone down because I think I confused everyone.
Okay. So that means you're saying essentially no way to kick them out if you.
Right now I would just say, yeah, don't even touch it. And a lot of these local cities where people like to focus are actually passing like anti-tenant harassment ordinances because they really don't want people to feel insecure in their housing. So if you are looking to acquire a property right now, I would just underwrite like at its current, like you're not doing anything for 6 months, right? Or whatever.
Right.
They're talking about extending that moratorium until September. So
Oh, they're already talking about that. Okay. Good to
yeah,
know
and
that.
which I think it will be too.
Okay. Cool. Any other questions?
Can you talk a little bit about some of the submarkets? You kind of started on that, Long Beach, Santa Ana, but just some of the other ones that you or your company kind of focus on and why.
Yeah. So I'm trying to think here. We're not like chasing cool, quote unquote, if that makes sense. And that's a problem when you're looking in LA, like with more inexperienced investors. They'll usually be like, oh, Silver Lake, oh, Echo Park, like I want to be there. That's where all the hipsters move. We're really trying to identify submarkets where there's a lot of value to be had still. And what I mean by that is you can still buy it at like a decent cap rate. And then ideally if tenants leave, we can re-rent at higher prices. So Long Beach we really like because it just has it has the port. It's very development friendly. They're actively soliciting a lot of new industry to the area. South Central, so like South LA, I guess is what they say now. That's a great market for workforce housing as well. And I wouldn't just like a lot of people when they start looking around South LA, it's like, oh, I want to be by USC for student housing. It's like, no, there's like tons of great deals around there, and people need to live there. It's like if you live in South LA, you're probably working in downtown LA or like the South Bay. You can either live in South LA or you can live in like Palmdale, and there's going to be a demand to be there. I would say if you are looking in South LA, look for multi-bedroom properties, because when those tenants turn over, you will want, if you can get like multiple working age adults in there, people will pay a premium for that. They'll stay longer, and you can charge like rents that are almost on par with some of these other more expensive submarkets. Westlake,
safe in South LA?
No, it's South LA, but I mean, I'm not managing it. I don't manage it. I have a property manager for that reason. Another area that's really hot, but it's almost like tapped out, is Westlake by downtown LA. You know where that is? Yeah, like the first building I bought was in Rampart. So, I mean, even that's kind of going. A lot of investors really like that Northern Orange County area because it's the biggest challenge of investing in California and like LA in that area. More than anything, it's this rent control stuff. And it's Northern Orange County is a little less. It's not as tenant friendly. It's a little more owner friendly, if that makes sense. So.
Cool. Any more questions?
Hi.
Hi.
Yeah. What do you think about going out of state? Like there's a lot of seminars taking you out of state, and what do you think about that?
Yeah, I think it can be great. It's just understanding out of state markets can get a little tricky. And the market is very frothy right now everywhere. I think if you are looking at going out of state, if you can get into a larger project, I would, because if you're buying like a 5-unit in LA and a 5-unit in Phoenix, you know, besides price point, you're probably going to still deal with like the same type of property manager, that sort of thing. But if you can get into these larger buildings, you can take advantage of like institutional property management and some of these larger kind of like, you know, opportunities that are created by, you know, as you scale up, and that'll drive your operational costs down. So.
Okay, yeah, because there's a lot of so-called investors right now going out of state, and supposedly they're buying 50 units, 100 units, but for me, it's like good luck, because you have to have, you know, management in place, everything in place, and I don't know their behavior over there, you know. I mean, we know that we understand tenants' behavior here in LA, but out of state, I mean, it could look attractive, but at the same time, it could be risky because we we don't understand the market.
Yeah, and one thing you for sure don't get quite like you do in LA is the big benefit is the appreciation here. I mean,
you're right. Appreciation. You're right, because it's tempting, you know, to go out of state, but at the same time, it's like, what? You know, I have a friend who lost 200 units in Texas, like 7 years ago. So he told me, study your market really good before you go out of state. So that's the reason that I'd rather stay here in Los Angeles.
yeah. If you're looking for out-of-state brokers, if you look for people with the CCIM designation, is what it's called, that could be very helpful.
Yeah.
What is that designation? I haven't heard about it.
CCIM.
Yeah.
It's kind of like you have to take some coursework and pass it, and it's like a degree of some sort, I guess.
What does it ensure? Does it ensure like a quality of something? I mean,
yeah, I would say it's analogous to working with the CFP, right? Is that what the, you know, or something like that?
Certified Financial Planner.
Yeah. They know how to at least underwrite and do that sort of stuff.
Okay. But the fact that they're broker or they have the license for broker, right? Wouldn't that ensure that they are good or they know what they're doing?
Yeah, I mean, I think as Californians, we all have to be a little careful when we go out of state, because our property prices are so, you know, like we got anywhere we go, stuff looks great, right? And so it's kind of like,
Right.
You know, just if everyone here's done a few deals, it's like, you know what you do. You get your numbers, you look at your P&Ls, you underwrite it, you do your thing, you model it out, you go visit the property, do your inspections, you know, so there is kind of a tried and true method to it. So
it makes sense. Yeah. Yeah. And you're absolutely right, because the property that I'm about acquiring, right? It's the price of that is same as my house here.
Yeah.
So,
yeah.
That's a 24-unit property.
Yeah. It's California is a great place to start your kind of portfolio. You know, hopefully someday, you know, I can be buying out of state all sorts of stuff and crushing my cash flow. But
yeah, because here in LA, you know, you like you said, you know, you own 2 units or 10 units. I mean, it's long term. And it's, I guess for me, it's less it's less risky to own properties here in LA, because you know that you're here, you manage your properties, and many landlords are long-term landlords over here. Whereas in Texas or out of state, I mean, you don't know. You have to have 100 units in order to make sense, and then you don't know what's gonna happen in the market. You know, with all these tornadoes, hurricanes, whatever. So you have more problems.
Yeah, and that appreciation occurs here in LA. The reason I like it, you're in LA, the LA basin, you're kind of buying in a geographically constrained market with this like powerhouse economy. So over
Yes.
time, that forces appreciation. you know, so.
You're right. You're right. And what do you think about? Because I'm planning on buying. I mean, there's a lot of developing going on right now in LA. But with this pandemic, whatever, do you think do you still do
I think it got cut off.
you still think that building units? That's what I mean.
The, the numbers got to work out, right? Have you ever heard the saying, the third developer in is the one who makes the money on a deal?
Never heard that.
Yeah,
What does that
it's
mean?
kinda like- It means that a lot of projects get started and stuff happens and people run out of money and they don't have much luck.
Oh wow.
Yeah, I would say if you can, you're probably better off just buying old apartment buildings and renovating them and buying tenants out. That's how you might save a little more money and put
You're
yourself
right.
at less risk. But if you can develop and put something up and pull it off successfully, you can make a lot of money and do very well, obviously. So
Yeah, because well, that's what I think too.
Cool. Any more questions?
So, John, I have a question. Do you have like a source that you use when you're underwriting properties to determine the cap rate for certain areas in LA?
yeah, we do. We'll usually look at, so if we're going into a new market, so let's say someone wants to go do a deal in Altadena or something. We don't do much in Altadena. I've done stuff in South Pass, but never in Altadena. We might go look at some different comp sales in the property of stuff that's closed and just calculate what the cap rates are ourselves. And then price out what that equates to. We'll also use a gross rent multiplier quite often as well if we're in a non-rent controlled market like Long Beach, to help us see if we're overpaying or underpaying relative to the other comp sales in the area.
Okay, and off of those comps that you're mentioning right now, they're giving you what, the NOI? Or are you just estimating it based on what you know about the market?
Well, yeah, those comps, we can calculate the NOI and the purchase price. So we know the average, if the assumption we're making is that we have the gross income and our assumption is a good operator in California will be, or 35% of that gross income is going to go towards expenses.
Got it.
So, and
Okay.
that's higher out of state. Yes, Costa Hawkins, Chris, I just looked at your chat. I couldn't remember that for the life of me. I was just like, what is it?
One question I have is, do you see people actually buying earthquake insurance for other properties? Because it's pretty expensive.
Yeah, no. Nobody buys earthquake insurance. It's crazy. And a couple of reasons, it kills your yield. The other thing is that when it doesn't insure against a total, like usually it'll only insure up to like, let's say you get a policy for $750,000. You got to have $750,000 worth of damage before it kicks in. You know what I mean? So it almost just like, all right, well,
So if the earthquake happens in LA, then pretty much all multifamily people are dead, right?
I don't know. Look at some of that 1920s product. It's been through quite a few and it's still standing. So
Yeah, it makes sense. Yeah.
We will retrofit a lot of our buildings though.
I see.
Yeah, we will do that.
That's the way of getting the insurance in a way.
Yeah.
I have earthquake insurance on mine.
Really?
Oh, yeah.
Is it still cash flow?
Oh yeah, big time.
Oh, that's a good deal.
But I've had them for some years, so there's been a lot of appreciation and rent appreciation.
Yeah, that's great.
Forgive me, I misunderstood. What was the name of the insurance you all are talking about right now?
Earthquake insurance?
Okay, got it.
Kind of on
sorry,
that
what?
line. Yeah, on the line of retrofitting, do you kind of purposely go out and look for, properties that aren't soft story retrofitted, so you kind of can go in and do that? Or do you kind of do the opposite, where it's like, I'm not going to look at this unless it is soft story retrofitted, so that I don't have to take on that extra expense and hassle?
Yeah, it depends on the geographic market. So like I said, we do a ton in Long Beach. It would surprise you. Long Beach has no retrofit requirements. And it is on what's that name for like a liquefaction area, right? It's all sand, and so what we are seeing though is some banks now are starting to require it. Again, it just depends on the numbers and the underwriting, right? Like it depends on per deal by deal. So as an investor. Usually when a client engages us, they'll come up and say, hey, I have X amount of equity I want to deploy and I want to make this return and I want to be out of it in Y number of years. And then we'll go work with them to kind of ID submarkets then and go from there and set them up with financing.
Cool. Any more questions?
Last question. When you reposition apartment, let's say that you buy an apartment. I mean, let's say that you see a deal right now under market, not under market, but low rents that you have to pay cash for keys to tenants. So of course you do your numbers and then you negotiate a price. So is there's any rule for you to, as far as to renovate, kick out those tenants and basically charge tab money, tab rent to your to those units? At that point, what do your cap rate or what's any rule of thumbs as far as your return on your money, or what's the potential to make here in Los Angeles for reposition deals?
Yeah. If you could, well, obviously if you can reposition a deal, you're in really great shape. When we're identifying projects, if it is a value add opportunity like that, either we get the price down or we bring more money in, but we really want to make we're usually pretty careful about it because I've worked with some tenants where at the last minute, like they're saying, oh, sorry, I don't want to take the money, I want to leave. And now in LA, the city actually has to approve your cash for key buyouts, technically.
What?
Yeah, there's a rescission period now where they can back out. Oh,
wow.
Yeah. So you have to be very careful about it. And I would recommend, if you're looking at a deal to look at, make sure that you can sustain that property if those tenants change their minds. LA is kind of a different beast, I think. In Santa Monica, they're kind of like a different, and those kind of those stricter rent control markets are a little harder to work in, but that's also where you can make the most money if you do it correctly. So
okay, yeah, okay, so sounds good. Basically just basically at this point when you're repositioning your properties, basically make sure that you have money for the tenant just in case he don't go out. Or sometimes I've been negotiating with this property I told the seller to leave money on the table in escrow, because he promised me that he wants to, that he's gonna kick out the tenant.
Oh, that's the biggest thing.
But I told him, put your money.
The seller will always say, oh, if the seller says he's gonna kick out the tenants, make sure the tenant is gone before you take possession of the property. Yeah. Like 150. I've seen that happen so many times. We're like, wait, they didn't leave. Like that happened to me on that first one I bought. It was like, and then the other thing when you're negotiating with them, with tenants, I've also learned from personal experience, come from a place of compassion to these people, because you are going into their homes and like trying to get them to leave. If you can go in and figure out like what's going to move for the needle for them personally, you catch more flies with honey. So like for one guy, I paid for his daughter's wedding. That was the cash for keys negotiation. He was allowed 20 grand under LA rent control. We actually got to pay him less because we figured out what the wedding budget was, and that's how we figured it out. He really wanted his daughter to have this wedding. So I was like, okay.
That's a good one. Yeah, that's a good one. Yeah, because it could be costly, especially right now with these eviction freezes. It could take months until June, right? We have until June now, and then I
I
don't know, it
think
could take 2-3 months later. You
I
never
think it'll
know.
get extended too. I think it's gonna go to September.
Oh my, yeah, and then plus September, then another 3 months until the judge, says, okay, you have extra 3 months to move out, free rent, and then you're talking about end of the year by that time.
Yeah, but a good leverage point now is if you're buying a property where a tenant is in arrears, you go to them, you say, hey, we're going to forgive the rent for you guys if you leave now. Don't worry about it. We're not going to file a claim. Here's your money and please leave. Tenants are getting more open to leaving, I've seen too.
So, oh, you had to pay on top of that, they don't pay you?
Yeah, we'll usually pay to get them out.
Oh, wow. They're lucky then. No, yeah, they don't pay you for 6 months, and then plus you have to bring money to the table to.
Yeah,
to do a cash
it's
for keys.
totally ridiculous, but usually the math works out where you make more if you can get them out sooner.
Yeah, for sure. Because your budget is usually like around 20,000, but you can get them out for less. That's great. Okay, that's great to know.
Do you want me to leave my email in the chat?
Yeah,
Yeah,
I think
put
if everybody can just put their contact information in the chat so that, and then you can save that information by saving the chat. So it's like on the bottom right corner, there's a 3 dots.
Oh,
And,
yeah.
if you click on that, then you'll save chat option appears. So John, thank you very much for sharing the state of LA market. It looks like there are opportunities if you really want to. So it's always helpful.
Yep.
Forgive me, VP. I had one more question for John. You
Sure,
mentioned
sure.
20,000 for LA tenant cash for keys. Is that like the minimum?
Oh yeah. In the city of Los Angeles, if you go to I believe it's the HCIDLA website,
Okay.
that will give you the minimum tenant buyouts. If you are in other local submarkets, that might be different. So like the city of Compton is not LA, you know what I mean? Or
Got
like
it.
Long Beach. So there's different. So like Long Beach, you don't have to pay as much to get people out.
Okay.
This is one last thing because we have a couple. I think everyone left is like kind of LA focused. On your leases, if you're looking to buy something new, there's a lot of tenants' rights groups like BASTA, Eviction Defense Network, the Shriver Project, and they target landlords who have weak leases with their tenants. So a lot of times when we go to buy a property, let's say like Ken or Chris or Christian, if you guys are going to go, or Kelly, if you guys are going to go look to buy a property, look at those leases, and there should be an attorney like mediation fee. And what you want to do is make sure those attorney's fees are limited to $500 or less on either side of the party if you get into a dispute. That way they're unable to take you to court. And if there is no clause like that limiting those attorney's fees, day one, when you take possession of that property, go on that front door and change those terms of tenancy immediately. Because what they will do, their leverage point is under the Constitution, everyone's allowed a jury trial. So they will take you, they'll file their lawsuit, they'll take you to a jury trial. And if you lose, because California is a pretty tenant-friendly state, you probably will, you have to pay all their attorney's fees along with the penalties that they're seeking, or the damages that they're seeking. So that, and then they'll show that to you, and then they'll say, or you can settle for X amount of money, something crazy. So that's just my little tip if you're looking in LA. So.
Oh, I see. That way, if that is limited, then they won't even try that route.
Mm-hmm.
Makes sense.
Yeah. So be very careful with that.
Very good tip.
And what are you buying right now? What's your criteria?
I'm building ADUs right now, but probably next, I'll probably just go try to find something with good cap rate, a good cap rate, and something that cash flows. I don't really care what it is, just Class C in a rougher part of LA. That's all I care about.
Well, yeah, ADUs are coming. Is good right now.
Yeah.
Thank you.
All right. I'm going to stop the recording.